Gautam Chhaochharia joins us, represents UBS. Gautam, good morning. Thank you for joining us. Gautam, the new buzz on the town is that there is going to be a new CEO in a private bank and then the stock is going to get re-rated. We've seen that happen to Axis Bank, ICICI Bank and now Yes Bank. So from an institutional investor standpoint, if someone calls you and says, Gautam bhai, what should I do? Should I buy private banks now because PSU banks are losing market share and the top 3 private banks now have a new CEO?
So we have been overweight private corporate banks and we still remain overweight private corporate banks. CEO change is just one factor. The fundamental factors matter a lot more. Within the broader private corporate banks, we are emphasizing those banks which have a retail liability franchise. So while we are overweight the overall space, the focus is on the ones which have retail liability franchise. The banks which don't really have a retail liability franchise and are more wholesale funded, in our view, still remain vulnerable to the environment we are in and the foreseeable future. So that's a differentiation we are emphasizing on to investors, and obviously we to look at what's priced into individual stocks, etc.
Bullish? Are you bearish? Are you in a wait and watch mode? What is your house view for 2019?
So for the broader markets, we're still cautious. We've looked at different scenarios of markets post-elections, given the election being a big event. We've also analyzed and tried to see what kind of policy environment will be there post-elections in different government scenarios, and then looked at what the market ranges could be in that environment. And looking at those scenarios, the risk reward to us still seems unattractive. Our base case for Nifty is 10,000 by December 19. Which suggests about 7-8% downside from current levels. So the risk reward is still not supportive for us to get constructive. And there are two simple reasons for that. First half is obviously the politics part, which will keep uncertainty high. And second part is for the second half, looking at the various policy options. What we're also seeing is increase in populism narrative ahead of elections. Could also mean the policy space is constrained for the first 6 to 12 months for any new government. To really kickstart the economy. So that's the other thing to keep an eye out on from a market's perspective. And keeping both of these in mind, it also remember the valuation. So while markets have corrected a bit, the de-rating hasn't been that dramatic at a broader at a Nifty level, while we have seen some de-rating at the mid-cap level. So that's what keeps us still cautious on the markets here.
Hi there, morning, and let's talk about that populism narrative. It really seems to be the word on the street in terms of how the budget is likely to be doled out this time around. How do you believe the overall political scenario is going to impact the equity markets? What are your expectations this time around from the budget?
So budget, this is likely to be a vote on account, as it always has been. Because whatever the budget talks about, it's a finance bill. It has to be passed by Parliament. But obviously the government can talk about the policy scenarios ahead. So they could talk about what they might do post the elections. But largely it will be a vote on account. Secondly, the political scenario, as we said, as of now it's uncertain. We don't know what will happen. We don't have a view on that. But it's important to think about how markets react to different government formation scenarios. And I'll give you two simple examples. The last 4.5 years, we have seen earnings growth being muted, earnings cuts happening, but markets have re-rated strongly and not done very well because the narrative on policy reforms, macro stability has been very, very strong and positive for markets. You go back to the late 90s when we had a third front government. The policy was actually fine. They didn't really do anything stupid in fiscal deficit. The reforms trajectory was largely continued. We had some bold tax measures also. But Indian markets de-rated and underperformed regional markets. Why? Because the markets worried about uncertainty on both political part as well as policy part. So that narrative also is relevant. So what kind of government we get post-election may or may not necessarily mean a dramatic shift in the real policy environment, but the market sentiment and narrative may get hurt depending on who forms the government. And therefore that matters for markets very, very clearly.
Linde India. Hello. 17% lower for Linde India. Now, they came out with an open offer which institutional investors did not accept. There was speculation in the market that institutional investors will force the management to come out with a revised open offer. The management saying, no ways, we will not come out with what the institutional investors want. We believe that the open offer at which we want to delist the company will not be revised. And the final twist in the tail has been that they've decided to withdraw the open offer. Now all the speculation, all the hum and drum which happens sometimes on some of these WhatsApp groups and all, leads to this kind of a disaster. And I'm being a strong votary for the longest time that stock market, if you buy on rumors, if you buy on unsolicited, unsubstantiated reports, if the event does not turn out the way you think it is, then you really could be in front of a firing squad. So India, and you look at the volatility in the stock now. I mean, we'll try and put some dates out also as to how exactly the entire, what has been the sequence of events here. But in terms of stock fall, it's falling on very, very, very strong volumes. I want to mark Jubilant FoodWorks. Why? Because suddenly there is a big spike in Jubilant FoodWorks. In last 5-7 minutes of trade, Jubilant FoodWorks has just rose and rose and rose. Gautam, we may talk about high valuations in FMCG companies. We may talk about overcrowded trades in some of the consumer staple stocks. But looking at the volume growth, I mean 10% for HUL on that large base, 20% for Asian Paints on that large base, 7-8% from ITC, which is now a behemoth also in the FMCG space. It just makes me wonder that is it time to remain bearish on staples? They may be expensive, but that's where the growth is.
So again, valuation reflects the challenge of lack of options in broader markets, while we'll still have strong inflows and liquidity, and this is a phenomena globally also, not just in India. Having said that, the volume uptick in staples has not been a surprise, at least to us. So our evidence lab work last year, middle of last year ahead of festive season, had suggested this, that while we might see, for example, volume disappointments in automobiles, in the staples we should see an uptick as volume trajectory normalizes for most of these companies. But again, you have to be stock selective, not a broad-based staples approach. And you have to also remember that the focus on rural India from the government side has been inching up over the last year and a half. So that's also possibly helping the staples deliver good volumes.
Okay. Gautam, do you think that FY20 would be a better earnings year for corporate India than what we've seen in FY19? And I primarily ask you this because with the election event around the corner, one can brace for a bit of volatility in the market. So irrespective of earnings, the market returns can be a bit patchy. Is that how you see it, or do you think the pickup in earnings will have an impact on the overall gains that investors make?
Earnings obviously matter because returns are a mix of earnings and multiples. So when you talk about narrative, it hurts multiples negatively, and obviously theoretically earnings can make up for that. But again, yeah, FY20 will definitely be a better year than last 6 years and FY19 for corporate India, for Nifty. And it will be back to double-digit earnings growth finally. So we are forecasting top down around 15-16% growth for Nifty. But again, a large part of it is I won't say optical, but driven by normalization in the financials NPL cycle. If you strip out the financials NPL driven recovery, then the underlying is still in single digits. So optically it will be good for the markets. But even at 15-16%, what it means is we'll see roughly 9% cut to street estimates. So earnings cuts will still be quite sharp in the next few months. But at a top-down level, it will still be a supportive thing for markets for sure.
All right, let's just visit the overall market. The scenario is that we're at 10,927. Remember, we did have a fairly healthy handover from overseas, and looks like we're piggybacking on that sentiment. 265 points up on the Sensex at 36,462. And the broader end of the market, mind you, this time around really seems to be following suit. Pull up the Nifty Bank as well. That index is lending a helping hand, up about 0.5%, and across the board you're getting support from every sector, be it infra, energy, FMCG, and even the IT index, which is holding out by about 0.7%. When it comes to the pecking order on the index, no doubt names like Yes Bank stand out. There's also Bharti Infratel, which is cooling its heels after yesterday's major downdrift. UPL is in the green, ONGC, HCL Technologies, as well as Axis Bank. L&T prior to numbers is firmly in the green, Sun Pharma, and even Maruti in top gear. It's literally 5 stocks in the red. Ultratech Cement after results yesterday, Hero MotoCorp, GAIL, and ICICI Bank, which is at about 363. Add to that Z Entertainment, which is looking a tad tempered in today's trading session. I wanted to get in a view then, Gautam. We spoke about the earnings season as a whole going forward, but what's the sense that you're getting when it comes to the overall capital goods space? Sense is that we could see the overall private capex cycle benefiting a lot of the capital goods companies in the quarter. What is the outlook on the overall earnings growth? Do you believe that with the upcoming budget as well, we may see some more reforms doled out which could potentially benefit the space as a whole?
So that's one sector where we again have a contrarian view. We don't see any uptick of a private capex cycle. A small uptick of a low base normalization, yes, but no beginning of a private capex cycle as such. And a couple of simple points, the point you mentioned about budget, etc. So when the populism narrative is rising ahead of elections, etc., the space left for helping capex obviously gets constrained, and we're already seeing signs of that in various government infrastructure initiatives already. Secondly, our capex analyst has done some interesting work, bottom-up work, which suggests that the signs of capex recovery, either in terms of capacity utilization, news flow, or commentary by corporates and actual numbers, actually represents roughly 20% of private capex. So if you break up private capex into different sectors, roughly 20% of that is likely to see an uptick, and roughly 50 to 60% of the private capex is in sectors where we don't see any visibility of capex cycle recovering anytime soon. So yes, the 20% will help optically private capex coming off from a low base to recover a bit, but no broad-based sharp uptick in private capex cycle for sure, at least for the foreseeable future.
So Gautam, what could go wrong this year? Elections we don't know. That's a binary. That's like an event. You and me sitting here cannot predict what will happen to the outcome of elections. Nobody can actually. We may speculate. We may have a view. We may have an opinion. So let's keep that aside. Fundamentally, what could go wrong?
So fundamentally, it's not elections, but into the elections, if the narrative towards populism becomes overbearing, which kind of takes away the policy space. We've already seen parties talking about pan-India farm loan waivers, other doles, etc. All of this could help or may not help politically, but it definitely means the space left for policymakers to drive a stronger economic recovery post-election becomes constrained. And that's really a worrying point from my perspective for markets, because otherwise India was quite well set post-elections. All the pain of GST, demon is behind us. The banking sectors finally seems to be coming back on track and would have been supportive of growth. And if we had a conducive policy environment post-elections, we could have seen at least some form of a cyclical recovery in India. But this populism narrative is something which is a dampener and could dampen that recovery for the first year of the government at least.
All right, let's just keep it with the mid caps and small caps. And what's the sense that you're getting here? You believe, I believe, Gautam, that you have a fairly underweight stance. We have seen a lot of investors getting their fingers burnt when it comes to trading in the broader end of the market. What's the view that you have as to how investors should now approach trading and investing in mid and small caps? Does it need to be a fairly stock-specific outlook? Okay, we seem to have disconnected that line. Well, speaking of the mid caps and small caps, let's just quickly check in as to what's going on in that universe. As I said, it's been pretty much neck to neck with the frontliners. So up 0.5% for the mid and the small cap indices as we speak. And there are individual names that are firing up the screen. Jindal Saw, we spoke of a nice 6% bump up there. You've got Edelweiss Financial as well, which is quoting knocking on the doors of about 160 in today's trading session. So that's a good 5% on that stock. Pfizer is sitting at 28.25. DHFL is another result candidate, and that's going to be closely watched out for in trade today. While Dilip Bilkon, ITI, VMart and Videocon Industries are holding out in the green. Gautam was curious about the outlook for how investors should be approaching the broader end of the market. Do you think that one needs to be fairly stock specific when it comes to investing in mid and small caps, if you can hear me?
Absolutely, absolutely. So as an asset class, we still remain underweight mid caps, just like last year, because while we have seen valuations correct, if you look at relative valuations of mid caps to large caps, they don't really give us comfort that this is the level where you jump in. And even if we strip out the loss-making small mid caps, they don't appear as expensive, but they're still related to large caps more expensive than they were in 07, 08. So still not risk reward attractive for the broader asset class of small mid caps, but yes, stock specific opportunities are there definitely, as always the case, and exist in select mid caps even now.
Right. Gautam, give us your sense on, what would you avoid in this market? I know we typically ask our guests about where they're bullish. What about the themes that you would be bearish on or underweight on?
So definitely be underweight in general cyclicals, given the policy space being constrained and the uncertainty around the elections, which includes capex, industrials, etc. Definitely be underweight mid caps. Still avoid them. The risk reward is still not attractive. And then while we have neutral stance on various sectors like autos, etc., there are enough stocks there where I think the correction or derating is not happened enough, or we don't see any